A government couldn't pay its war debts, so a group of merchants made a deal in a London coffeehouse that accidentally invented the modern central bank. It's 1694. England's been fighting wars for years. The treasury is empty. The king needs money fast, but there's a problem. Nobody trusts the government to pay them back. So a group of London merchants walk into a coffeehouse and propose something radical. They'll lend the crown a massive sum of money. In exchange, they get a charter to create a bank. This bank doesn't exist yet. It's just an idea scribbled on paper. Here's the setup. England's government is broke because of the War of the League of Augsburg. Wars cost money, soldiers need food, weapons, uniforms. The crown had borrowed from private lenders before, but nobody wanted to lend anymore. The risk was too high. Default was always possible, so the merchants saw an opening. The merchant's offer was this: we'll give you £2 million. That's enormous money in 1694. In return, you charter us as a bank. We get the right to take deposits, make loans, and this is the key part, issue banknotes. Paper money backed by our reputation and our capital. Now, paper money wasn't new, but the Bank of England's version was different. When you deposited gold or silver coins, the bank gave you a note. That note was a promise. Bring it back, we'll give you the metal. It was a receipt. But here's what made it revolutionary. People started trading the notes themselves instead of going back to redeem them. The paper became money. Exhibit 1, the war debt problem gets solved. The crown gets its £2 million. The bank gets a monopoly on note issuing in England for a set period. Everyone wins, or so it seems. But now the bank has a new power. It can lend out more money than it actually has in gold sitting in its vault. This is fractional reserve banking. It sounds complicated, but it's actually how every bank works today. Let's say you deposit £100 in gold. The bank keeps maybe £20 in the vault. It lends out £80 to someone else. Both you and the borrower think you have money at the bank, and as long as not everyone shows up at once demanding gold, the system works. Exhibit 2, the bank's notes become more trusted than the crown's own currency. This is wild. The government issued coins, sure, but the Bank of England's notes were actually worth more because people believed in the bank's ability to back them with gold. The private institution became more credible than the state. Fast forward 50 years, wars happen, crises happen. Sometimes there are bank runs, everyone tries to withdraw their gold at once. The bank nearly collapses a few times, but each time the government steps in to prop it up. Why? Because now the economy depends on it. The bank is too big to fail. Exhibit 3, the Bank of England gradually becomes the government's bank, not just a private business. It starts managing the national debt. It lends to the crown during emergencies. It becomes the lender of last resort, the place other banks turn to when they are in trouble. This role wasn't written into the original charter, it just happened. By the 1800s, the Bank of England had evolved into something nobody in that 1694 coffeehouse could have predicted. It wasn't just a bank anymore. It was a central bank, the institution that controls the money supply, sets interest rates, and acts as the financial backbone of the entire nation. Here's what's remarkable. This wasn't planned. There was no master blueprint for central banking. The Bank of England didn't start as a central bank. It started as a solution to one specific problem, a government with no money and creditors who wouldn't lend. The merchants who proposed this deal were solving for their own interests. They wanted profit and security. They wanted a monopoly on note issuing. But in solving for themselves, they created an institutional structure that every modern nation copied. Central banks exist worldwide today because of that 1694 agreement. The United States didn't have a central bank until 1913 when it created the Federal Reserve. France, Germany, Italy, they all built central banks modeled on the Bank of England. Even today, when governments face financial crises, central banks step in to stabilize the system. That role traces directly back to 1694. So what made the Bank of England different from other banks? It had a government charter. It had a monopoly. It had the trust of the crown. But more importantly, it had a problem to solve that nobody else could solve. That's what gave it power. Think of it this way: you need a loan, but nobody trusts you. A friend offers to vouch for you, to sign a guarantee that says, if this person can't pay, I will. Suddenly, lenders trust you. The Bank of England did that for the English government. It said, we guarantee the crown's debts. And here's the final piece. Once you're the guarantor, you have power. If the crown spends too much, you can say no. If the crown needs money fast, you can demand terms. The Bank of England's control over the money supply gave it leverage over the government itself. So the claim stands: a war debt and a coffeehouse conversation created the modern central bank, not through grand planning, but through necessity. A government needed money. Merchants wanted profit and security. Their deal became the template for how nations manage money today. That's how institutions are actually born, not from theory, but from solving the crisis in front of you. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe to learn how other financial systems that shape your life today started as practical solutions to forgotten crises. This video is for educational and informational purposes only and is not financial advice. Always do your own research.